1 in 10 Americans is still out of work. So what kind of numbers do we need to see before we can say that the U.S. economy is truly on the mend and that the Fed can start bringing in some of the stimulus dollars that have been floating out there in the economy? John Ryding is the founder and chief economist of RDQ Economics. He's also a former New York Fed senior economist and Bear Stearns chief U.S. economist, and he's joining me now live in studio. Gary Schilling says 8.5% unemployment is where we're going to have to see the jobless number come down to before the Fed can move.
I think we need to be in that neighborhood before the Fed will move, because if we look at the last 2 recoveries, the Fed waited a year or so after the peak in the unemployment rate before making its move to raise rates for the first time. And of course, this time we're peaking at a much higher level of unemployment, and the Fed thinks that unemployment is the primary determinant of inflation. I myself think the Fed ought to move sooner on account of the weakness in the dollar and the strength of commodity prices, but that's not something that the Fed's paying particular attention to. Yeah,
that sounds like a little bit more of a European approach. There is a tremendous amount of attention paid here to jobless numbers. When Schilling was speaking earlier in that soundbite we just ran, he was saying really, by not too soon, he doesn't even mean in 2010. He's looking for 2011 before the Fed can comfortably move here.
Well, our forecast has been for a long while the Fed will not hike rates in 2010, and that first move will come in 2011.
Okay.
And unfortunately, in doing so, the Fed runs the risk of repeating the policy error of 2003 and 2004 that set us up for the big boom in leverage and credit by maintaining rates so low for such a long period of time. Look, the economy is recovering. The labor market is not yet recovering. But job creation is going to need more than monetary policy stimulus. It's really about incentives to hire and costs of hiring labor. And right now, government policy in terms of health care and other policies is potentially imposing significant costs on employers for hiring labor. And that is that's something that should be addressed rather than keeping interest rates at 0.
But it seems to all be coming back to this argument again and again about where growth and how much growth needs to come from the consumer segment of the economy and how much is going to come from business spending. Which area is going to grow first and which one will help lead the other out?
Well, it will be,
where do you aim?
It will be business spending. Right now, it's the inventory dynamics that's driving GDP growth. It's also the global trade dynamics. We see recoveries in both import and export volumes and a recovery in business spending. All of that will bring about job growth, and job growth will bring the consumer along in its wake. This was not really a consumer-driven recession. It was really an implosion of credit that hit businesses very hard. And as the credit market stabilizes, we start to see a recovery, and we'll see that recovery in business spending. We're seeing it particularly strongly in the fourth quarter in inventories, which could push GDP growth significantly in excess of 4% in the current quarter. And today's industrial production numbers perhaps a sign that we're seeing that broad-based manufacturing growth in the current quarter.
And you would wave off concerns about inflation that surfaced after that headline, industrial production.
Well, we're concerned about inflation, but I don't think inflation's a problem for now. I think inflation's going to be a problem in a year or so's time. And at that stage, if the Fed's still at 0 rates because of the unemployment rate, which they probably will be, and still at a $2 trillion plus balance sheet, we are concerned they won't be able to shrink the balance sheet and begin raising rates and changing policy fast enough, which, as I said, was the policy error of 2003-2004 that led to the boom in credit and led to actually the recession that the economy exited from last quarter.
So will we see a move on discount rates in 2010 or in the nearer term?
Well, obviously that was a story that was floated as an outside possibility in the Financial Times today. I think it's unlikely, but remember the first move the Fed made was to narrow the spread from the Fed funds rate to the discount window. They did that back in August 2007 before they began cutting interest rates. The problem is, without properly explaining that to the market as to why they might be doing it, the market might misinterpret that as an early move to tighten policy with Fed funds increases following on behind. I think tomorrow the Fed's going to reiterate extended period, and they're going to keep the message simple so the market won't misunderstand. And so I don't think they'll be moving on the discount rate anytime soon.
All right. Thank you so much, John Ryding.